A suspect is being questioned in the shooting of Unitedhealth CEO Brian Thompson. Homebuilder Toll Brothers is reporting earnings even as we speak, and we'll take a look at those stocks and another homebuilder, Lennar, which will report next Wednesday after the close, today on Open Interest. Hello, everybody, and welcome. I'm Mike Coe. Welcome to Open Mic. We will discuss UnitedHealth in a few minutes, but first, we're going to discuss the home builders. Since the beginning of the fourth quarter of this year, the home building industry has underperformed the broad market materially. For example, of the 11 building products companies that reported this quarter, only 4 have outperformed the S&P from the day before their earnings release through this past Friday. And as a group, they've underperformed the S&P 500 by about 5.1% on average. Of the 17 home building companies that have reported, only 3 have outperformed the broad market, and as a group, they've underperformed the S&P by 5.2%. 2 large home builders are reporting. Toll, as we speak, and Lennar will be reporting next Wednesday. And in theory, both of these companies should be benefiting from housing demand. But they serve very different demographics, and comparing the respective segments these 2 builders occupy to home builders that have already reported this quarter may provide some insights into why the sector has been under some pressure. Interestingly, none of the 3 home builders that have outperformed, remember I said there were 17 that have reported, only 3 outperformed the S&P from the day prior to their earnings through the end of last week. Only of those, none of them really are in the median home price segment. So Taylor Morrison closed on about 11,500 homes at an average price of about $623,000 last year, and that price is about 50% higher than the median in the United States. And the other 2 that outperformed are Cavco Industries and Champion Homes, and both of those sell manufacturer, prefab, and mobile housing at prices that are much lower than the $400,000 median home price. So the average earnings price change for the 10 home builders with selling prices that are sort of close to the median, so between $350,000 and $550,000, those are down an average of 9.4% from the day prior to their earnings through last Friday. And it suggests that building and selling homes to the average working American is challenging in this environment. And that happens to be right where Lennar falls. So their average selling price was $422,000 last quarter. By contrast, Toll Brothers, which we're going to take a look at in a second, serves a much higher income group. Their average closing price fell from about $1,071,000 or so in the third quarter of last year to about $970,000 or so in the third quarter of this year. But that is still well more than double the median home price in the United States. And so they're serving a much more affluent clientele. And that may be one of the reasons that Toll has outperformed Lennar by about 10% since the beginning of this quarter. So that outperformance, incidentally, also happens to account for the difference in their relative valuation. So Toll is trading at about 11.3 times forward earnings, or it was, at least as of the close, versus about 10.2 times for Lennar. Now, there's one other premium that distinguishes these 2, and that is the volatility associated with them. And if we share my screen, I'm just going to quickly point something out here. So I have touched on this subject before. Hopefully we can blow this up a little bit, or if I need to, I can just hit the magnifying lens here a bit, just make this a little bit larger so we can get a good look, because I realize there's a lot of digits on here. So let me see if I can get this to a point where it's fairly easy to read. Okay, so I'm just going to use my cursor here. The numbers that I want you to pay attention to, Toll is a smaller company than Lennar, but the numbers I want you to pay attention to are the market capitalization and the enterprise value. So understanding the relationship between these 2 numbers has a lot to do with, or can have a lot to do with, options premiums, especially when you are comparing 2 companies that are within the same industry. And what you're going to observe here is that the enterprise value is significantly larger than the market capitalization. So it's about $2.1 billion higher. And basically what enterprise value does is it calculates the value of the enterprise net of debt. So, for example, in this case, you can take $2.9 billion or thereabouts in total debt, take out $900 million, and that gets you to $2 billion in net debt. So you can sort of think about this as the value of the equity and the debt put together, which is obviously a more important way to think about it. So when the value of the business changes by 10%, the value of the business is going to be changing by, give or take, in a 10% move, $1.8 billion. So that will be a bigger percentage of $15.8 billion, which is how you're actually going to see that price change reflected. Compare that now to Lennar, and what you're going to see, and here I need to blow this up as well so we can get a good look at this. So what you're going to notice here is that this company actually doesn't have any net debt. So it's got about $4.25 billion in cash, and it actually has slightly less total debt than that. So the enterprise value is actually very slightly smaller. And where this starts to matter is when you start looking at companies that have a lot of net cash on their balance sheet. Now, of course, some of the big tech companies have really endeavored to try to resolve that situation, as Meta has, for example. You'll notice here this company has about $20 billion in net cash, and that's because they've taken out $50 billion or thereabouts in debt because they were able to borrow at a decent length of time at very low interest rates. Apple was able to do the same thing, and then they can use that money plus the cash that they have on hand to repurchase shares, which is accretive, and obviously lock in fairly attractive rates of funding. These companies are probably not going to be issuing too much debt right now. So, and actually, why don't we take a quick peek? We're just going to see if we got any numbers out of Toll, and if so, whether I can see where the stock is now trading. Let's see. Okay, did we get numbers out of them yet? Because they are reporting today after they close. We have not gotten numbers. Okay, so we'll keep our eye on that and wait to see what happens. But I did want to talk a little bit more about the dynamics that are affecting the housing market, because there's something going on here which it's possible some people haven't really contemplated that much. Obviously, the issue of inflation remains a problem. But some of those inflationary pressures, so what I'm talking about now are things like the cost of materials like lumber, concrete, and steel, which rose significantly in the supply chain and inflationary period that followed the pandemic. And so that obviously was a bit of a problem. And then also the rate dynamic. So we had a situation where rates went to historic lows, and that propelled home prices. Now, this doesn't correct automatically when rates fall. So actually, I can just throw I think I can get the bank rate 30-year mortgage up here on the chart. So we can just take a quick peek at that over time. See if I have it. I do. Okay. So let's just take this back. Let's go back 20 years. I think that's probably a worthwhile exercise. And you can see just how sharply mortgage rates have risen. Now, the interesting thing that maybe some people don't think about is that if you lower rates significantly, it can drive home prices much, much higher. The problem is that if you then raise rates because you've created that housing price inflation, that doesn't necessarily correct the problem. And in fact, strangely, it can exacerbate home price affordability. Why is that? Well, one of the reasons, of course, is that the payments on a mortgage in this new higher rate environment are substantially higher. Second is that prices rise quickly in the real estate market, but thanks to things like bailouts that we saw in the GFC and so on, they aren't inclined to fall as quickly. And finally, it actually constrains supply. And the reason it constrains supply is that you can imagine if there are a number of people out there that have either purchased homes at significantly lower mortgage rates or refinanced at significantly lower rates, if they now sell their homes and look to move, they are faced with the rather daunting prospect that they would have to refinance at substantially higher prices. In other words, it introduces a huge amount of friction for them to sell and relocate, even to a comparably priced home, if they are financing the purchase. And frankly, even if they're not financing the purchase, because the overnight rates, risk-free rates on cash balances have also gone up. So you're going to be sacrificing either income, or you're going to be making a larger mortgage payment, or potentially both. So this constrains supply of existing homes. So when you think about that, then the higher rates create pressure on new home builders in the sense that it increases the payments, but it should increase demand for new homes because that is an area that doesn't necessarily have that same friction. That is to say, the friction of people who are locked into their homes, essentially trapped in them, if you will, because they currently have a relatively low rate of inflation, of interest. Now, there is another dynamic that I don't hear getting discussed a whole lot, and I think we should just talk about the total quantity of the housing shortage as it's currently estimated in the United States. So in June of this year, Zillow, according to their analysis, reported a shortage of 4.5 million homes. And while a housing shortage would generally create a tailwind for home builders, obviously we've talked about the affordability, the costs, we should also talk about how we came up with that housing shortage. So over the last several years, we have seen very high levels of immigration. So according to the Office of Homeland Security Statistics, which is part of DHS, since January of 2021, the United States has granted lawful permanent resident status to just over 3.9 million people through the third quarter of this year. And of those, 1.7 million are what are called new arrivals. So that's sort of the number that we're more interested in, rather than those who are granted legal status but were already here. The United States has also experienced a significant increase in unauthorized immigration. So the U.S. Customs and Border Protection Agency has reported over 10 million encounters with migrants nationwide, also since January of 2021, with approximately 8 million of those occurring along the southwest border. And in addition to those encounters, there are an estimated 1.6 million what are so-called gotaways. And those are individuals who entered the country illegally without being apprehended. And that was estimated between February of 2021 and October of 2023. So when you combine all of these figures together, the total number of people entering the United States since January of 2021 exceeds the 11 million unauthorized plus the 1.7 million new arrivals who obtain lawful permanent resident status. That works out to about 12.7 million people. So how many housing units are needed for that number? Well, the average household size for foreign-born households in the United States is about 3.5 people for owner-occupied homes and about 3.1 people for renter-occupied dwellings. So that would suggest that the incremental demand as a result of the immigration, both legal and illegal, since 2021 is somewhere between 3.6 and 4.1 million housing units. Now, remember, according to Zillow, we're shy by about 4.5 million. So that represents about 80 to 90% of the estimated housing unit shortage. Now, historically, undocumented immigrants tend to have lower incomes compared to legal immigrants and U.S.-born individuals. And so, consequently, many of those are going to struggle to find affordable housing. Now, if the federal government steps in, federal, state, and local governments, I should say, to come in to subsidize all of that, that would have two important costs. First of all, the taxpayers obviously have to pay the freight, but it creates that invisible tax of inflation as well. Now, why do I bring all of this up? I bring all of this up because the incoming administration made it a large part of their platform to enforce border security more than the current administration has done over the course of the last several years. And so that would suggest that the pace of immigration should slow. The incoming, quote, border czar, Todd Homan, I think his name is Todd, first name is Todd, his last name is Homan. I know he has said that he was going to focus primarily first on trying to deport illegal immigrants who are what they're calling criminals. So in terms of criminals, according apparently to the deputy director of ICE, 435,719 convicted criminals entered the country illegally and were released. And another 226,847 had pending criminal charges. So in total, we're closing on 660,000 plus people that they are looking to deport. That at least was according to the Deputy Director Patrick Leitner, I don't know if I'm pronouncing that correctly, in a letter to U.S. Representative Tony Gonzalez last July. So what does all of this mean, though, for folks in the home building industry? Well, a couple of things are going on here. For one, the home building industry does employ a significant number of immigrants, and a good percentage of those are thought to be undocumented. Still, the number of undocumented immigrants clearly is exceeding by large amounts their contribution to the housing supply. So to a certain extent, that should create some alleviating pressure. But the other part of the equation that we need to see improve is going to have to be the rate side. And I have a hard time believing that the rate picture is going to improve materially, since most of the secular tailwinds to create lower rates of inflation have currently reversed. Globalization, free trade, that is not something that's really high on the list of priorities, quite the opposite of the incoming administration. So when you put all of those things together, that's a little bit worrisome. And the other thing I would say, and I'm going to actually see if I can pull up a chart of CPI as well. There's one other thing that worries me here a little bit. Is this the right one? Okay. So I'm going to go back in time here quite some ways, and I hope this will be visible. Let's see what we have. I probably went back too far, actually. I don't need to go back quite that far. Let's go back to 1970. So if we look at the cycle of inflation that took place, it was in the early 1970s when the Fed had excessively easy monetary policy. Apparently under some pressure from then President Richard Nixon to keep rates and things like that artificially low. That created this first big bump in inflation. Now, you can see that inflation actually hit 12.3%. This is the measure of using CPI. CPI may or may not be your favorite one, but let's just use it as the benchmark for now, even though we know that the Fed has other preferred measures. It reached about 12.3%. It did fall back in the mid-70s, only to about 5%, so it certainly didn't come back that much, before spiking to an even higher level in late 1979 and in early 1980. That was the end of Jimmy Carter's presidency and the beginning of Ronald Reagan's. It was this precipitous inflationary decline that was motivated by then Fed Reserve Chairman Paul Volcker's extremely aggressive monetary tightening, taking rates to the double digits and finally stamping out inflation for good. Why do I bring this up now? Well, what worries me is that we could potentially face a similar dynamic here. And if we did, inflation could resurge once again. And remember that the second surge that we saw in the 1970s, I'm not saying that's necessarily what's going to happen. There appear to be some efforts being made not in that direction, but we're talking about it would actually get up into this region here if it was going to follow that same pattern. I don't think we would get back to quite the same levels of inflation that we previously saw, but if we saw a similar order of magnitude in terms of its increase, we're looking at inflation rates that could actually hit 10% or so. And that would, of course, be highly, highly problematic. Okay, so I know we have some questions, and I'm going to get to those. I just did want to address Unitedhealth very quickly as well, because when I was asked about this last week, I think I neglected to fairly contemplate the implications on UnitedHealth's stock. So let's take a look at UnitedHealth's stock here for just a moment, since this tragic shooting that took place in Manhattan a week ago. So one of the things you're going to observe, and I'm going to put the overnights in here as well. I think this should. So one of the things you're going to observe is that when this happened, after initially falling, UnitedHealth actually ended up trading higher that day. Remember, that was the day that the company was holding their investor meeting in Manhattan at the Midtown Hilton, hotel where I've actually stayed many, many times. And when I was asked about this, one of the things I said was that Brian Thompson, while a 20-year veteran of the company, was, maybe a very important cog, but a cog in a much, larger wheel, one that was larger than himself. UnitedHealth had long since proven its ability to grow over the course of time, as we can see here. So we're dealing with a company that was growing the top line and has been growing the top line in the low single digits and the high single digits and low double digits for a very long time, and has been growing earnings per share at a significantly faster rate. It is a cash flow generating monster. And what I suggested when I made my remarks about the price action at that time was that it probably was the sense amongst investors that although this was a tragic event, it would not materially impact the company's ongoing operations. With the benefit of hindsight, because the stock has certainly weakened a bit since then, bounced back today as we can see, what I had not anticipated was the motivations necessary, or really truly contemplated, I think, were the motivations of the shooter. Now, they have identified and are now questioning a very strong suspect in this case. That individual's name is Luigi Mangione. Luigi Mangione, the interesting thing about him, there's a couple things, but it appears that this is somebody who had a real axe to grind, possibly about corporate America generally, but about the insurance business specifically. Couple of reasons why we believe this. One is that it was not until a day or so after the event took place that they realized that words had been written on the brass, on the cases of the ammunition that was used at the time. I believe the words deny, defend, and depose were found. That is a little bit different than the old saw about insurance companies, which is deny, delay, defend. But it did certainly suggest that this person was making a comment, perhaps specifically about UnitedHealth and perhaps specifically about healthcare insurers, and that he had an issue. That seems to be confirmed today when they captured this suspect. One of the things that he had in his possession, in addition to a weapon that matched the description of that provided and the one that we can see in those very grainy photos, was a 3-page manifesto where he rails about these issues. And it seems that there has, at least on social media and elsewhere, been a little bit of a backlash, public backlash about this. And I think it's safe to say that there is a decent amount of dissatisfaction with the way the United States healthcare system works. What this means, of course, is that this could put some more scrutiny on the company than I had originally thought this event might cause. So on Fast Money last week, we had an analyst on, I believe, from Mizuho, and he was speaking about the lack of transparency on claim denials at managed care companies like UnitedHealth. I don't know whether this is going to create a whole lot more scrutiny. But I figured we would just talk about an options trade if you happen to hold the stock. This is a very broadly held stock. It's one of the largest companies in America. But we should just sort of think about a couple things that are going on here. So for one, the stock topped out at its all-time highs of about $630 quite recently. It was only about a month ago or so. I suspect it's going to be difficult for the stock to really break out to the upside under a cloud of increased scrutiny that this event could have caused. Now, I don't know that it's going to cause it, but it certainly is a risk. Something else has happened, and that is that the implied volatility, so I'm just going to unclick the historical here, but the implied volatility is now much higher than it was before all of this took place. It's in a little bit, but it is still much higher. My thinking on this is that it might make sense, if you own the stock, to consider selling some upside calls at this point, because the premiums are high and this could weigh on it a little bit. I'm not sure that it will, but it could. One other quick thing to contemplate in all of this is the stock's multiple, right? So this is not a badly priced stock by any means, not certainly when you think about the rate of earnings growth that we've seen. But if we go back, let's just say 10 years, and we take a look at the average multiple. So on average over the course of the last 10 years, the company is traded at about 19.5 times forward earnings. It's currently trading at about 22 times. Is 22 times forward earnings too expensive for a company that is growing at the pace of UnitedHealth? No, I don't think so. Not when the S&P is not growing as quickly and is trading at a higher multiple. But I do think that it's likely this could potentially bump its head. So what do? If you own the stock, one thing you could contemplate doing is selling some covered calls here. Taking advantage of the fact that options premiums are elevated, recognizing that breaking out to new highs might be less likely. Number one, considering the fact that the stock had rolled over even before all of this, but if there's any cloud on the industry, and it does seem to be getting a bit more scrutiny, those are things that could potentially weigh on it. So what might one do? Let's go here. So if you hold this, that's another thing, is that technically it seems to be breaking down as well. But I'm not necessarily saying that if you hold the shares, you should sell them, because that could incur some tax implications. But it is worth considering, at the very least, potentially selling some upside premium against it. And because options are now a little bit higher in terms of implied volatility than they are historically, this is also a circumstance where I would probably be comfortable going out a little bit further than I normally would. So generally I say, you're looking at 30 days, 45 days, maybe at the outside. The reason that we like to look at selling calls against stock shorter dated is because, as a function of their own value, options will tend to decay more rapidly as expiration approaches. That's part of it. The other is that I don't like to sell massive amounts of premium through things like earnings when stocks are more likely to move fairly sharply. So if you own a stock because you like it, you rarely want to start selling premium going into something like earnings. In this case, some of the potential overhang that the stock may experience could go through something like earnings. So they're estimated to report the second week of January. I've got the Bloomberg terminal showing me the 13th. So one could go to weeklies, go to weeklies a week before if you didn't want to do that, and sell some upside call options. to collect a little bit of premium. In this case, and remember, I like to look for perhaps 1% or so at a minimum for a 1 month option. The idea being, as I've previously stated, that you are looking to capture a rate of return that is similar to what equities give you in general. And actually, over the recent couple of years, that number has been actually substantially greater than 1% a month. But if you own the stock, you also have some room for capital appreciation. So, for example, here, you could sell the 600s for about $6.20 a contract. That's more than 1% over the course of 1 month. You still have about $40 worth of upside, give or take, from the current stock price. So in total, you are going to be looking at a decent rate of return should it get up to that short call strike. So I wanted to throw that out there in United Health. There were other things I thought we could potentially talk about with respect to what was going on there, although I think it's less important to do that now. I happen to have, Jay, who's one of our producers, who's on. I have some experience with, things related to firearms. There was a lot of question about that, about what the shooter had used, how he got his hands on it, things like that. And our producer, who actually was who competed in the space, he would be able to give us some more insights. But now, actually, that they've captured a suspect who's looking very likely to be the guy, we're probably going to learn a little bit more. The other thing, I think, that whenever we have a well-publicized incident, that it's worth thinking about is whether there are any implications for publicly traded companies that are in, the firearms trade. But in this particular instance, it's looking like this is a firearm that this guy may have made himself. My guess is that if he made the firearm himself, he very likely made the suppressor that was attached to it himself as well. So there may not be manufacturers associated with that are going to get scrutiny if this is something he made at home, and that may also account for the struggles he had with the weapon strike cycling at the time. Okay, so let's get to some questions. Happier subjects, hopefully. FinWest says, from last Monday, you fielded a viewer's comment who wanted to buy calls on an expected rise in the VIX. I have the same outlook, being an option seller. What about selling some puts instead? That is fine. I would rather sell puts on the VIX than I would on the S&P, that's for sure. And frankly, probably then selling some upside calls in the S&P also, because, and we're going to get to some of these questions as well, we're still in this melt-up mode. Just a quick thing to remember, though, and that is that if you sell VIX puts, this is, I'm going to highlight this so we can see this curve a little better, hopefully. Can I do that? Show up better, come on. I want you guys to be able to, actually, I guess you can see this chart pretty well. Okay, you can see this fine. Just remember that when the normal shape of the VIX term structure is very similar to the normal shape of the volatility term structure in the S&P complex. So when I say the S&P complex, I am talking about IBV, I am talking about SPY, I am talking about SPX. And that is that longer dated options will tend to have higher implied volatilities than the nearer dated ones do. When you translate that into a VIX world, what that means is that longer dated VIX futures are going to have higher prices. And if you look closely, if you see these things sort of flashing green or red, you can see a little green arrow here, there, and there. So as time passes, if you sold a put, let's say on the May future, that's this one, after 30 days, if nothing changes in the term structure, you're going to be short a future with about this much time to expiration. And it will, the future, most likely be at a lower level. And similarly, this will be true once it gets to March, and so on. So the put that you want to sell you're looking to balance your forecast for the fact that in a normal market condition, the price of those futures is going to go down and gravitate towards the put strike that you are short. So if we're going to be a little bit more specific, and why wouldn't we be? Come up with a specific one. So let's just go out to February, let's say. So you might do something like sell the 13.5 strike put, which is 30 cents or so. So that's 30 cents relative to 13.5. So you're going to be collecting about 2.2% of the put strike. Bear in mind that the VIX is not going to go to zero. So this isn't exactly the same as selling a 13.5 strike put on a highly volatile stock. The other thing is you are going to see that the skew perspective where downside puts traded higher implied volatilities in the S&P and SPY and in all of the indices and their proxies generally, the opposite is going to be true on a volatility product. So the downside puts are going to have lower implied volatilities than the upside calls will. But yeah, I think that's a fine strategy, bearing in mind, so we're looking at the February 13.5s, so those are trading at about 30 to 40. So imagine that you looked at the 13.5s going out 1 month. So here, there's a difference in days to expiration of about 27 days here. So these are 35.48. They are only a small amount higher than these are. So you can imagine that with the passage of time, because that future is coming down, and because the vol of vol, I realize this is getting a little wonky, but the vol of vol near dated is higher, the implied volatility of VIX options is actually going to be going up, and the price of the VIX futures is going down. So while this is a fine strategy, just bear in mind that the rate of decay that you would expect to collect on that 13.5 put might not be quite as high as it would be if you were looking at something that behaved more like an equity does. So you are dealing, like I said, you're dealing with a couple different things here. Vol of vol, that's the volatility of implied volatility on the VIX, is going to have a different type of a term structure than the index does. And the futures have a downward sloping term structure. So let me just show the implied volatility over time in VIX, and you're going to see what I mean. So you'll notice here that the nearer dated futures have higher implied volatility than the long dated ones. But the actual price of the VIX futures, I don't know if I can actually superimpose the curve. We're just going to toggle back and forth. So the term structure of the futures is upward sloping, but the term structure of volatility on those futures is downward sloping as you go further out in time. So you have those two forces that are reducing the theta, the positive decay that you collect for selling downside puts and VIX futures. I hope that helps. A lot to digest there, I realize that, but something to think about. Okay. Ranjana Gupta asks about Vistra. So this was, a super high flyer. This was part of this infrastructure trade on things like data centers, big increase in demand for electric power, essentially. Now, some of you may remember that we had a conversation about this several weeks ago. The name that I talked about at the time was Fluor. So Fluor is an engineering, procurement, and construction company. So I don't know, maybe somebody can get my ear and tell me exactly when it was that we had discussed it, but it was back in November, I believe, maybe, that we were talking about Fluor. Remember that my thinking on that was that Vistra and some of the utilities had already had such a phenomenal run that I was looking for sort of derivative plays. And Fluor has something else interesting. I'm only just going to talk about this first, but they also have an investment in a Washington state-based small modular reactor company, which is a startup. It's pre-revenue, but it was just another way to potentially play it. So let me see here. I just got a pop-up here. When did we talk about it? It was, back on November 13th. Is that what I'm seeing? Yeah, so we talked about Fluor back here. Oh, well, that was, looks like that was pretty well timed. It's better to be lucky than good sometimes, because obviously the stock looks like it's done pretty decently since. But I still like that one. So on the Vistra front, two things. One, what's our technical view? Because fundamentals aside, fundamentals are not great trading. We care a lot about fundamentals in the sense that if you're going to have a long-term hold in something, it's good to have a fundamental foundation for that. And, how do I view this stock if I was forced to hold it for a year, for 5, for 10, forever? If you're going to be long something, think about that. If your hands were tied behind your back and you could not sell it, how would you feel about that? So to me, that defines the difference between a trading opportunity and an investment opportunity. So in the shorter term, technicals matter a lot. Right now, the technicals for Vistra, despite the fact that we've seen this big decline, look a little bit more bullish, it would seem, than bearish. So we have 5 bearish signals right now. Oh, I'm sorry, 6. And those are the commodity channel, MACD, K-band, moving average oscillator, Rex oscillator, and the rate of change. We have a larger number of bullish signals. As I often say, ignore the buy and hold in this, because buy and hold is obviously not a technical indicator. It's only in here as a placeholder. And then we have a couple of these which are neither in nor out and have effectively no position in the name right now. I like to look also just sort of at longer term smoothing mechanisms, like those articulated by my good friend and colleague Carter Worth. And he tends to favor the 100. Oops, I put in the 15. That's not what I wanted. He tends to favor the 150-day moving average. So we will put that in. And we are pretty extended above that. Just my own observation. Yeah, that's a pretty big gap. And I know that when it gets a little too far above that, he tends to get a little bit anxious about it. My thinking is that, let's take a look also. I just want to see one other thing, because I did mention that one should always pay some attention to the fundamentals. Just how would we feel about owning it in the long term at these levels? 26 times forward, which, if they are growing by at least, so that's not terrible, but it does feel a little bit extended to me. So if you were looking for a trade, and I'm guessing that some of this choppiness has probably contributed to an increase in options premiums, and they are pretty high. So we're going to just take a look at that. Okay, so actually, this may set up pretty well for something like a call spread risk reversal. So you give yourself a little bit of a buffer, take advantage of that elevated premium, and like that. So what might something like that look like? Now, bear in mind, a call spread risk reversal is, it's another way to kind of, you're selling more options than you're long. It's a bullish position. It has capped gains, and you have a risk of being put to stock. So despite all of the legs, if you think about this trade as another way to sell puts, a more nuanced way to sell puts, but if you sort of say to yourself, that's what I'm doing here, that'll give you a sense of whether or not this is a trade with a risk characteristic that you're comfortable with. But something like that might make some sense. Probably pushing it into next year. I think you're not likely to see big tax increases that would make something like this less attractive. Again, that's a function of the election. So consequently, you might try to get something on it fairly close to zero cost. And the stock's around 561. I'm just going to bump it up to, we'll call it the first out of the money strike, or what was that, a 50 delta? Let's go 50, or yeah, 50 delta is probably fine. And then selling a downside put. So we need to do something down in this neighborhood or so. We could even bump that up a little bit more. A trade like this, just because we are getting some sort of gaps in here, and actually that does give me one other quick thing that I think we ought to look at. Do we have any unfilled gaps to worry about right here? We don't. There is a potential level of support right in here. So the valuation's not terrible given their projected growth. It does feel extended, though, as a stock, and it seems to be reacting very poorly today. We're also in this only the second day of a fairly severe move lower. And, I've spoken in the past about sort of a 3-day rule. You might want to think about that. Just sort of wait and see whether you get some institutional stuff going on. So that's something I would think about. Michael Kane says, thank you for having these sessions. What is your view on defense stocks with the recent events since the election? Yeah, it's a funny thing because we often talk about defense stocks in the context of geopolitical events around the world. When we think about things like elections. The truth is, though, that these companies, it's pretty difficult to materially change the defense budget and our spending with defense companies. I'm going to leave Boeing to the side because Boeing's got enough issues with the commercial side that even though they're a meaningful defense contractor, I'm just going to separate them. So that's why we're looking here at Lockheed. But the fact is that it seems like these are businesses, as we can see, we just go back in time, these are businesses which tend to grow fairly steadily regardless of who's in the White House, regardless of who controls Congress, and regardless of what wars, and it seems like we're always involved in one somewhere, are going on. So, in general, this is kind of a safe and stable business. If they decided to overhaul defense spending to get rid of programs like the F-35, which is a really expensive program, and it's not going to be up to Trump to say, okay, we're going to overhaul how the Air Force and the Navy think about their air power, and whether they are going to, as Elon Musk has significantly encouraged, to an unmanned air fleet. But it is fairly clear that modern warfare is transitioning increasingly to drones. And the significance of that is that those projects could be less costly, but it also would be a new project. To the extent that we decide to overhaul our fleet of aircraft to unmanned, for example, they're considerably less money, but they could come online much quicker. I don't really see the defense contractors as being harmed either way. And certainly from what I have seen about the way these programs get instituted and selected, is that the military has their own view of the way things should go. Presumably, if somebody runs artillery, they think, for a long time we're probably trying to encourage investment in antiquated military technologies that aren't really applicable in the real world, but that doesn't mean we just completely squash our M1A1 and subsequent armored division, armored programs and things like that. So I like them generally. I don't think, I think actually I'm more concerned about the geopolitical situation in the East than I am in the Middle East right now. I mean, the Middle East is a big mess, and it has been a mess for a long time. What's going on in Syria with the fall of the Assad regime I don't know that that's going to meaningfully change our defense spending with respect to the defense contractors. Major military skirmishes, if any, should arise with bigger powers are a more meaningful concern and would increase spending, but would also bring a lot of new players in as well. So don't know if that helps you, but that's my thinking. Steve Garcia says, good afternoon from sunny Marin. So you're not far from me, since I assume you mean Marin County, California. The stock market can build wealth over time. Is the options market just a zero-sum game, or is there a legit role using options for building wealth as well? Well, obviously, I think there is a legitimate role for the use of options. Options have a couple meaningful roles to play. One is that they are a form of insurance on the underlying equity, and that has significant utility. It has very important utility for institutional investors that may have uncertain investment flows. So, for example, trusts, endowments, where you have beneficiaries coming and going, their contributions may rise at some points, the distributions may rise at other points, and oftentimes distributions increase, contributions decrease right at the same time that equity markets decrease. Why is that? It is because oftentimes you're looking for cost cutting, early retirements, things of this nature when you go into an economic slump, and that can often mean a decline in risk asset prices. That creates negative convexity for these big institutional investors. This was something that was highlighted by one of the managers from the University of Chicago's endowment. So they play a very important role. Derivatives are also embedded into a lot of investment products that regular investors are using whether they know it or not, such as equity-linked annuities. Those things have an embedded volatility component. It was typically sold to the insurers by banks. And so it is actually a component of a lot of investment products, whether or not people realize it or not, because I think people have a tendency to sort of look at listed options as derivative instruments, and they don't really recognize their connection to everything else that's going on, but they have an important role. If you sell downside puts habitually, this has been shown to be a very steady way to get equity-like returns, not quite as high to the upside, but a little bit steadier, although they do exhibit negative convexity. So you're essentially getting into the same position that those aforementioned institutions are. But the short version is that there is absolutely a good way to do this. There is also a lot of bad ways to do this. And oftentimes people who get into trading options straight away, they are enamored of the idea that they can control large amounts of stock with relatively small amounts of capital. And that leverage and the promise, if they happen to get their bets right, of getting very high rates of return in very short periods of time, have very low probabilities of success. And so that is really more user error than it is a flaw of the underlying product. So the short version is, yes, you can improve your risk-adjusted investment performance using options. No question, professional traders do exactly that. Can they be misused if they aren't deployed appropriately? Absolutely. Which is one of the reasons, by the way, when I am highlighting, different options trades that people can use, I'm assuming they're being sized in the same way that the underlying stock would be. Instead of trading 100 shares, you trade a call spread risk reversal. Your downside risk in that case is actually less than it otherwise would be. I'll give you another example. I was talking to a local family office here. I've spoken to a couple people in this area. It's not uncommon in the Bay Area to find people who worked for some period of time for NVIDIA. If you worked for NVIDIA, you got stock grants. If you had stock grants and you didn't sell it, you very likely have become exceptionally wealthy as a result of all of this. There are tax consequences for selling your stock. They may not want to incur them, particularly if they're residents of California, where there's not really a concept of capital gains, so they could face very dire tax consequences if they sold, but they can actually do things like collar their stock. I'll give you an example of this. If you go out in time, so this is for somebody who's owned their stock for, call it 10 years, you could collar your stock, for example, And because interest rates have risen, that elevates the price of calls. What did I do here? That work? There. Okay. Because interest rates have risen, that elevates, all else equal, the value of longer dated calls relative to puts. What that means is you can now get an asymmetric payoff. So if I owned, let's just say for the sake of argument, and this argument is honestly not that unusual out here, believe it or not. There are people who have 100 million, they have 1 million shares of NVIDIA. Okay, so they're have more than $100 million worth of the stock. They don't want to sell it. They don't want to have the tax consequences of doing that. They like the company fundamentally. In many cases, they like the company because they worked there, because they believe in the promise of all of the things that they saw while they were working there and the people that they worked with, even more so than Wall Street does or other retail investors. So what they might be interested in doing is saying, okay, well, I want to hold on to this for the long term, but I want to be insured in the event that the stock falls back because it's had such a run. I mean, they've become immensely wealthy doing this. So they might buy a very long-dated put. Let's say 1,800 days to expiration. Now, this is not something you're going to find in the listed market, but you can create it via flexes. You can create it in OTC structures. You can create it. It is a synthetic component of other types of over-the-counter derivative instruments, such as prepaid forwards that the investment banks will sell to ultra-high net worth individuals. So, oops, I didn't mean to change the share quantity. Sorry about that. We're just going to assume 100 shares. I meant to change the amount of time to expiration. But check this out, because I think this is going to be very interesting to some of you. And that is that if we go way out in time, because of this interest rate dynamic, and the interest rate dynamic is an arbitrage concept, but for somebody who's already long the stock, they could sell their stock and earn a risk-free rate on it, but they're not likely to do that. They own the stock. So let's just take a look here. Let's say that you decided to purchase a 10% out of the money put. Okay? And then you're looking for a call to potentially sell against that of similar time to maturity. What option would you need to sell in order to accomplish that? Well, if I sell a 10% out of the money call, so now it's just a 50-50 shot. Now, look, this is 1,800 days away. It's 5 years away. You're not interested in taking a punter for 10% on NVIDIA over that period of time. But I want to illustrate something here. You would actually collect about 16.8% of the current stock price here and now in premium to put that trade on. So you would have this option trade. If you had $100 million, you're going to take in close to $17 million in premium, and you'll have equal upside and downside. But let's say you didn't care to take in any premium. You said, okay, well, what if I sell a 20% out of the money call? You're still taking in 14%. What about a 50% out of the money call? You're still taking in 8%. So if you had 1 million shares, your downside risk at this point is, that's a $138 million position of equity that you earned while you were working at the company. You don't need to risk. And that 8%, by the way, is all of the potential downside. So effectively, there is no downside. So you're getting half of the upside of the current stock price with no downside if you held this to expiration. For many of you watching, you probably don't hold that position. But this is to answer that question about whether or not there's value to options. I think this sufficiently answers that question. The answer is 100%. There is. So, all righty then. Okay. Let's pick another one. Toll Brothers stock is up. It has reported. Yeah, let's take a look at that. So, some of you may know or may not know that I also write articles. I wrote an article for CNBC. It was published this morning, and I wrote an article that was published on our website, theoptionsedge.com. which was about Toll Brothers and Lennar. I said I favored Toll Brothers, and I gave a trade idea. The trade idea I gave was, in fact, a diagonal call spread risk reversal. I believe it was the 141, 155, 175 bullish bet. And I don't know where the stock is currently trading. We'll see. It's let's see, where's my after hours? I think Yahoo. I'm not getting a real-time update in this one right now. Where's after hours trading? Up small. Is that what we got? Down small. Doesn't look like it has much changed. I'm going to wait for this to update. The prices I'm seeing are a little bit inconsistent. This looks like this is actually down a little bit. But my guess is that the trade, the diagonal call spread risk reversal that I talked about, which was selling a short dated strangle against buying longer dated calls, is probably going to be up tomorrow, given this move. If it stays in this region, look, it's too early to say, but that's because that strangle is going to essentially go out worthless, and it will probably more than pay for the decay in and decline of the underlying stock. So I think one of the producers is showing me. Yeah, okay, so that after hours is just showing a 3% decline, which is well inside the implied move, which was close to 7. The reason it was 7, as I pointed out, bigger than the Lennar move, was because, in part because of that balance sheet leverage issue. So the volatility, all else equal, the volatility of Toll Brothers equity should be about 14% higher as a function of the increase in leverage on their balance sheet. That is, that they have more debt than equity. Debt than cash, excuse me. So they're carrying net debt. If you have a directional, AMTB says, if you have a directional trade going against you, is neutralizing delta a means to hold on without further bleeding, or should you cut your losses? Well, that depends a little bit, of course. The answer to that is yes. Let's say, for the sake of argument, that, especially if you want to hit the pause button. So let me give you an example of where something like that. Unitedhealth is a good example. Unitedhealth is a company I've followed for a very, very long time. I've mentioned before, Cheryl Skolnick, who's an executive there, was a colleague, ran research at CRT Capital when I was there. That was 12 years ago or so. Thought really highly of her. I've thought really highly of that company, at least as an operating business. We'll get to whether or not what's going on now uncovers, I'm not going to call it malfeasance, that's not quite fair, but if what happened last week puts pressure on these companies to change their business practices, or if we learn in the course of this that there are business practices that we don't personally agree with, that could pressure the stock. So ignoring all of that, this is a company that we certainly would like, but we're waiting to find out. And maybe it's a long-term holding. So you've had it since 2012. The stock is up many-fold since then. You could buy puts, or you could buy put spreads and neutralize the delta of your holdings while more information comes to light, without incurring a tax consequence on the stock if you should continue to hold it. You will have tax consequences as a function of your options trading on that, but that you might find that to be worth it. And I would suggest that if you were thinking about doing that, if any of you own Unitedhealth, then you probably want to use put spreads rather than puts, because as I pointed out, selling upside calls, being a net seller premium right now makes sense because options premiums are elevated. Or maybe you could buy a put spread, supported by that call spread. So I know we've covered an hour here, but I'm going to try to punch through some more of these questions for those of you who I have not yet gotten to. I'm going to try to get through a little bit more, assuming producer Jay, are you able to stay with me for just a little bit longer, or what's your time schedule here? Okay, so we're going to try to see what we can get through in the next 10 minutes here. So that with respect to neutralizing delta, that's a context where I would be interested in doing that. Selling call spreads, yes, exactly. Those would make sense. Steve Garcia says, why should denying claims for the sake of augmenting cash flow and benefiting shareholders be something that is celebrated. I don't think it is. At least I hope it isn't. Beneficiaries who have legitimate claims shouldn't see those claims denied, and I hope that's not what investigate. I hope if that is going on, and this brings attention to that. Now, Melissa Lee was interviewing somebody a couple of days ago, and he seemed to be confirming that the denial rates at Unitedhealth might be a little bit higher, but he also said that access to this kind of data is remarkably sparse. And what's interesting is that this guy, Luigi Mangione, this is not some buffoon. This guy has a bachelor's degree in computer science engineering from the University of Pennsylvania. He has a master's in the same. He has a minor in mathematics. He is an advisor at Stanford. This is not... It's interesting to me that he's a data scientist of sorts, or so it would seem. It suggests that maybe he has access to some of this data, and maybe that motivated this. I don't know. But I will say that I think that the upside is a little bit limited till we have some better sense of this. Mike, there is tremendous dissatisfaction with the U.S. healthcare system. It affects everyone. I am one of those people, by the way, who loathes it. Absolutely loathes it. It seems like a perverse hybrid of socialized insurance programs and private, and a lack of... And the interesting thing is that with private health insurance, we seem to have a shocking inflexibility. I have had to deal with this myself just recently with insurance with my kids, and I was trying to get them something. I was told you can't have that in the state of California at this time because it's against the law to buy, for example, major medical coverage exclusively. I have actually been one of those people. You probably don't know that many people who've done this. I, despite having health insurance for the whole family, had my own private physician that I paid out of pocket when I lived in Austin because it was just a much better experience. And believe it or not, it wasn't even that expensive. Everything was cheaper if I went through him than what the insurance company would have to pay by a lot. And everything was so much simpler. So I agree with you, Steve. It's repulsive what we have right now. And I don't know how... There's a lot of aspects of it that need fixing. But the problem is that patchwork solutions and Band-Aids have only made this particular patient sicker. So yeah. Let's see here. Okay. Well, just a couple more questions I can get to. MM says, hi, Mike. I've been selling 20 to 30-day 10 Delta up and down iron condors on SPX and booking regular income. Happily, no black swan events so far interrupting the strategy. Any thoughts? So first of all, I love that strategy in general because one of the things that we see is that index options, ETF options, do tend to be more overpriced than single stock options do. And there are less individual catalysts that can affect it. Here's the downside. Implied correlation, which is the relationship between prices on options for the indices and the ETFs and other index proxies relative to single stocks, got quite depressed this year. It has come back a little bit. I do see some potential risk. I see some signs. We have very high valuations on equities. I kind of like selling upside more than downside right here. That's why I think folks were, it's a little bit testy. I would say that selling the downside, just give yourself a nice buffer because I think we're probably a little overdue for a pullback. I'm not a great, I'm not a market timer per se. I'm sure there are a lot of people who have more insights on that than I do. But with respect to selling strangles, that's something I would be aware of. And a 10 Delta put on the S&P can, you can make a buck or lose considerably more than that if things go sideways. Okay, so with that, I know that we're now 10 minutes over the time that I had originally scheduled. Producer Jay is in my ear, and he has to move on to his next obligation, which means we can't continue. But I really want to thank all of you who stuck around for this slightly longer than average open mic live stream. Like, subscribe, put your comments into the YouTube channel so that we can review them, and we'll try to address them in the next one, which we're going to be doing on Wednesday at 4:15 Eastern Time. Thanks for watching.